Hello again, this is Andrew Westhof, Senior Loan Officer and owner of Homes Mortgage Lending. And today I want to talk to you about what lenders are looking for when they're reviewing your bank statements and other asset statements. Most loan programs we're going to require 2 months bank statements. There may be other loan programs that require more, but that's generally the rule. So talk to your loan officer to verify that. But I want to talk to you about what we're actually looking for when we're looking at those statements. So first and foremost, we want to make sure you've got enough money for the home purchase. So if you have $30,000 between your closing costs and down payment, we need to see that you have that $30,000 in an account in your name, or that the funds are gifted to you. I'm going to make a separate video about gift funds because there's a lot of variables on that, and I don't want to make this video super long, but that should be coming out in the next week or two. So if that's something that pertains to you, please subscribe and keep an eye out for that. But in general, we need to make sure that those funds are your funds. We can't just have you say, hey, don't worry about it. I'll have the funds at closing. It's none of your business where they came from. There's a ton of rules and regulations that are out there to make sure that loans aren't being done to fund terrorism or to launder money or things like that. So that's the reason that we have the rules that we have to really make sure that these are your funds. When we review the actual transactions, we're looking for large deposits. The underwriter's looking to see if there's money coming into your account that they don't know where it came from. The biggest issue here is going to be cash deposits because we can almost never verify cash. I say almost never because I have had it before where clients have withdrawn money from one bank account and then turn around and drove across town and deposited it into their other bank account. So I did get exceptions in those in some of those cases where the underwriter was allowing us to use it because it was pretty obvious that those were the same funds. But I've also had underwriters say no in that situation. And then really outside of that, even if it's just a day that's passed, I've never had an underwriter say, yeah, we can use that if it's cash. We just don't know where cash came from, and once it's out of the bank, it's no longer sourceable. So if you have cash on hand, like I mentioned, we're going to typically need 2 months bank statements. If you deposit it now, it's going to, and it's going to be more than 2 months before you get pre-approved. We're not going to see that deposit on the statements. It's considered seasoned, or really any place where your funds are coming from that we can't verify where they came from. If you deposit that now and wait 2 months, then they're considered seasoned, and we can go ahead and use those funds because the underwriter is not going to see them. So other things for large deposits, like if someone writes you a personal check, if it's a family member, we can probably call it a gift, but again, look for that other video to go in more detail on that. But if it's just a friend or someone owed you money or you sold a car, then there's a lot of things where money's coming in and it may or may not be something that we can source. So you need to talk to your lender about that if you have those funds coming in. A good loan officer, when they're pre-approving you, is going to scan through and see those large deposits and talk to you about them up front. But it's best to bring them up yourself. Whoops. They're also looking for money moving around, meaning money coming into your account from other accounts, transfers. So this can be an issue if it's not your account. If it is, it's not a huge deal, except for now we need to get those other statements from the account the money was transferred in from. And a lot of times the statement dates don't match up perfectly, and then we have to get additional documentation from you, like transaction history, to verify where the money came from and make sure we have a money trail from the whole the money took to get to the account you're using. So for instance, say you just transferred $5,000 into your bank account on like May 5th, and your statement dates for that bank account go from the middle of the month to the middle of the next month. So you have a statement from like March 14th to April 15th, and then from April 16th to May 17th, something like that. So we see on May 5th on that statement from April to May that you had $5,000 come in from your credit union, but we're still in May, and the money from the credit union, their statements go from the first date of the month to the end of the month. So now we get the 2 month statements, and we go, oh well, this only goes. We have the full month of March and the full month of April. So to get that transaction on May 5th, we're going to need to get you to get transaction history for 5 days, from the 1st of May to the 5th of May. So to do that, you can go online if the credit union has the transaction history printable, and we're going to require that there's a URL and a couple other pieces of information to verify it's your account. That's the same account, and print it out. Unfortunately, in my experience, especially credit unions, they don't always have that on there. In fact, most of them don't. So you can't print the format that we need. We can never take screenshots. And if they have something similar, but it doesn't have a URL, which is the little website at the bottom or top of the page, then we can't use it. So what you have to do is go into the branch and have them print out the statement dates that we need, and they have a special little stamp that they stamp it with and sign it so that we can validate it that way. So that in and of itself is a pain. But now that we looked at those new statements, if there's money moving into that credit union account from a different place or has a large deposit, now we're going to ask about that. So it can open a can of worms pretty easily. It becomes annoying at worst. Annoying at best, I should say. At worst, if something pops up, like, hey, maybe that's a joint account with a parent and there's an auto loan on there. Well, now we have to go back to your parents and get the statements for the auto loan to show that you're not on that loan, so we don't have to include that in your debt-to-income ratio. So the best advice is to keep those accounts as clean as possible and avoid moving money around as much as you can. Now, if you have a bank statement that has, a savings account and a checking account on it, or multiple accounts, and they're running through the same dates, that's fine if you're transferring money through the same bank and it's all in the same statement, because we're going to see the money move from account A to account B right on that same statement. So if you have any questions on that, post them in the show notes for your specific situation, and I'll try to answer it because it can be a little bit confusing. But if you can avoid making transfers at least a couple months before you're looking to get pre-approved and purchase a home, that's going to make life easier for everybody. And then the other thing that the underwriter is looking for is undisclosed recurring debt. So they're looking for things like installment debt, like a car loan. So if they see a payment going to Ford, on the same date each month, they're going to go, hey, that's probably an auto lease or a car loan. So we need to either document that it's not yours, or we need to document that if it is yours, what's that payment, and include it into your ratios. So housing debt, definitely disclose to your loan officer up front if you own a home, because we find it on the bank statement a lot of times when we see a mortgage payment or we see a payment for property taxes or homeowners insurance or homeowners association dues, because the underwriter is definitely going to ask about it if they see that, to see if you have a home and to include that into your liabilities as well. Same thing with spousal debt. If you're paying spousal debt, let us know up front, because we often will see it and it's required to be included. You don't want to hide that stuff. But yeah, if we see a payment for something like child support, we're going to ask about it and need to include it. Excuse me. And then federal debt. So if you're making payments to like the IRS to pay off a tax lien or something like that, the underwriter is going to definitely ask about it. And then lastly, you want to try to avoid having insufficient funds fees right before you try to purchase a home. That's a pretty big red flag to underwriters, because it shows that you're not paying, you spent money that you didn't have in your bank account. Now, I've had clients that have, had a situation where they, accidentally spent money on an account that they didn't mean to, and then they, paid it right back, and they had the funds available in a different account. That's usually not as big of a deal. But when we start to see, you've got insufficient funds fees, you've got a bunch of them, and it looks like you're just, you don't have the funds available all the time for the money that you're spending. That's going to look really bad. It could cause you to not qualify for the loan for certain loan programs. So long story short, keep your accounts as simple as possible. And then I want to also let you know, especially on a home purchase, if you're, when you're paying your earnest money deposit, we're going to need to source those funds as well. So make sure that you're paying that earnest money deposit from an account that you're either already showed us or are planning on showing us. Because I've had clients before who have gone, oh, well, I have plenty of money in my account, but I don't have checks for that account, whatever the case is. Talk to your loan officer about it up front if you're planning on using a different account, because we'll need to see 2 months of those statements, and we'll need to see typically those funds leaving your account. So don't show us an account that don't do it from an account you weren't planning on showing us. So here's what lenders aren't looking for. Here's the stuff you can kind of have a sigh of relief on. So we're not asking for anything that happened prior to the statements that are required. And again, most loan programs, it's going to be 2 months. talk to your loan officer in case they need to see more than 2 months. But everything prior to those 2 months we consider seasoned. So if you put cash in the account because you were saving up for the home purchase and you let it sit there for 2 full statement cycles and we don't see it on the statement, then you can use those funds. We don't, aside from the undisclosed recurring debts that we're looking for when we're looking at your money leaving your account, we don't really care what money's being spent on. So you don't have to worry about, how often you're going out to eat or you're getting coffee in the morning or whatever the case. I often have clients that are nervous because they go, well, the underwriter is going to see X, Y, or Z on how I'm spending my money. Are they going to be concerned about giving me the loan? Nope, we don't care, except for the new recurring debt, which I just mentioned. If there's debt on there that we don't know about, and then we don't care how much money you have left over. So if your cash needed for closing, meaning your down payment plus closing costs, is $30,000 and you've got $31,000 in the bank, we're good. Some loans require reserves. Usually on a primary residence purchase, there's no reserve requirement. So if you have a reserve requirement, meaning X amount of dollars we need to verify after the home is purchased, then we need to see those funds too. But if there's no reserve requirements, or even if there is a reserve requirement, after we meet that reserve requirement, we don't care if you have a penny left in your account or $1 million left in your account. So typically you don't need to show us other accounts that you don't need for the home purchase, like your retirement accounts or your separate checking account that's you have $300 in. Like, we don't really need to see that stuff in general. You don't get any better loan terms for it. There is some situations where showing more assets is the difference maker on being able to qualify, but it never affects your interest rate. So I hope this video was helpful. I'm going to make similar videos along these lines. So if this was helpful, please subscribe. And if you have any questions, please feel free to leave them in the video comments. I'll also post my contact information if you're thinking about purchasing a home in Michigan. I'm licensed anywhere in the state of Michigan. I would be very happy to help you. So please feel free to reach out to me if you would have any questions specific to you, or if you're looking to work with a knowledgeable loan officer. Thank you so much.